If you've ever looked at a startup that isn't even making a profit and wondered, how on earth is that thing worth billions of dollars? Well, you are absolutely in the right place. I'm an analyst with Talk Tickers, and today we're going to pull back the curtain on the very opaque world of private company valuations. Because right now there is a massive, massive reset happening, and we're here to deconstruct the new rules of the game.
So, how much is a unicorn startup really worth? I mean, it seems like a simple question, right? But the answer is, well, it's incredibly complex. See, for a public company, it's easy. You just look at the stock price. But for private companies, that's a whole different ballgame. For the longest time, valuing them has been way more of an art than a science. And let me tell you, that entire canvas is being repainted right now.
And this quote from investor Elizabeth Yin, wow, it just cuts right to the heart of it. Fair is irrelevant. Only market-clearing numbers matter. This really gets at a huge misconception that's been around for years. You see, a startup's valuation wasn't necessarily its intrinsic value. No, it was its price. It was simply the number that an investor was willing to pay to get a piece of the action.
All right, so here's a quick look at our roadmap today. First up, we'll tackle the valuation puzzle itself. Then, we're going to dive into the key metrics you need to know. After that, we'll look at the old boom time playbook, figure out why it's totally broken now, and then look forward to what's next. We'll wrap it all up with the key takeaways.
Okay, let's dive right into that valuation puzzle. The thing to really get your head around is this. When a venture capitalist invests in a startup, that big valuation number you hear about, it's really just the price they agreed on. And that price is shaped by so much more than just how the company is doing. We're talking market hype, what other similar companies are going for, and, of course, a huge dose of FOMO, that classic fear of missing out on the next big thing. And this really lays it out perfectly, the two sides of the coin. On the one hand, you've got price. This is all about the market, right? What people are willing to pay. And that critic analysis makes a fantastic point. This can get really circular. One investor pays a high price, which makes the next investor think it's worth that much. And boom, you've got a bubble. But then, on the other hand, you have value. This is the more, let's call it the sober, nuts and bolts assessment of what the company is actually worth based on its fundamentals. It's what you see in those 409A valuations for tax stuff. And boy, that gap between price and value, it's become a massive chasm recently. Okay, so to really understand the massive shift that's going on, we gotta speak the language. We need to decode some of the key accounting rules and the metrics that this whole industry is built on. And right at the heart of all this is something called ASC 820, which is just fair value accounting. All it really is a set of rules for how you value stuff on paper. And the key concept, the thing you have to remember, is the exit price. Basically, it doesn't matter what you paid for an asset. What matters is what you could theoretically sell it for today. So how do you figure out that exit price? Well, you use this hierarchy. Think of it as a ladder of reliability. At the very top, level 1, that's the gold standard. We're talking about things with a clear market price, like a share of Apple stock, super straightforward. Level 2 is for similar stuff, where you can make a pretty good comparison. But, and this is the really important part, a ton of venture capital investments fall into level 3. This is where there is no active market. So the venture capitalists have to basically guess. They make their own assumptions. And as you can probably imagine, that's where things get very subjective. All right, so how do these VCs actually measure how well they're doing? Well, for a long time, it's all come down to two key acronyms. First, there's TVPI. Think of this as your paper return. It's kind of like the Zillow estimate of your house. It's a great number to look at, makes you feel good, but it's not actual cash in your hand. Then there's DPI. This is the cash return. This is the money that actually hits your bank account when you sell the house. And for years, believe me, everyone was obsessed with TVPI. But oh, how the tide is turning.
So to really get why that focus is shifting so dramatically, we have to rewind a bit and look at the playbook that everyone was using during the big bull market. It was a very specific strategy, and it was all about pumping up those paper returns.
And here's what that old playbook looked like. It was pretty simple, really. A company's valuation, it was just the price of its latest funding round. The number one goal was just to get that TVPI, the paper gains, as high as possible. And to cover their bases, VCs used all sorts of terms like liquidation preferences, which basically acted as a safety net to protect their investment. The whole system was designed to keep those on-paper gains looking fantastic, even if a company was starting to stumble.
But then, everything changed. The whole economic climate shifted. Interest rates went up, the public markets got shaky, and just like that, the music stopped. And that old playbook? It became totally useless. Overnight.
I mean, think about it. IPOs, basically frozen. Big acquisitions, put on hold. New funding rounds, they just dried up. And you can see it right here in the data from Jeffries. Transaction volume absolutely plummeted, down a whopping 25% in the first half of 2023. This created a massive problem because that price of the last round, the number that was the bedrock of the entire old playbook, was suddenly completely and utterly stale.
So what are VCs doing about it? How are they adapting? Well, here is the big number. Based on our analysis of data from Common Fund, covering over 30 venture firms, we found that managers are now, on average, marking down their companies by 23% from their last valuation. Let that sink in. 23%. That is a huge admission.
Now, what this does is it creates what they're calling a valuation buffer. It's kind of a cushion in case things get even worse. But it's so much more than that. It is a loud and clear signal from these fund managers that those crazy sky-high prices from the boom times, they're gone. The massive gap between the hype and the reality is finally showing up in the numbers. And all of this has created a completely new reality. And with it, a new mantra in the world of venture capital. It's simple. Forget the paper gains. Cash is king. I mean, this quote from VC Stack just says it all. DPI is the new fundraising deck. What that means is, when a VC firm wants to raise more money, their own investors, the LPs, they only care about one thing now. They're all saying, show me the actual money. That DPI number, your cash return, has become the single most important part of the pitch.
So why this sudden obsession with cash? Well, a big part of it is that with so few exits happening, these investors are just starved for cash. But there's something deeper going on. They've been burned. They have seen a glorious 3x paper return, a TVPI of 3 completely evaporate. But a 1x DPI? A 1x cash return? That's real. That's money they can actually take to the bank.
And this pressure, this demand for real cash, is forcing VCs to get seriously creative. They're now using tactics that, honestly, used to be kind of niche. We're talking about things like selling off parts of their best investments early on the secondary market or setting up these revenue-sharing deals. It's all about one thing: finding any way possible to generate distributions and get cash back into the hands of their investors.
Okay, so let's pull it all together. What does all of this actually mean? What should you take away from this huge market reset? And what does the future of venture capital even look like now?
Well, welcome to the new normal. Here's what it looks like. First, cash is everything. DPI is the ultimate proof of success. Second, selling on the secondary market isn't a sign of trouble anymore. It's a mainstream strategy. Third, valuation discipline is back, and it's here to stay. But the biggest takeaway, the most important shift of all, is this. We are moving away from an industry that ran on hype and who you know, and into one where cold, hard, demonstrable returns are the only thing that truly matters.
And that leaves us with one last big question. Could this new era of discipline actually be a good thing in the long run? Is it possible that a focus on real cash returns and more stable capital will create a healthier ecosystem for both founders and investors? And maybe, just maybe, will this force venture capital to get back to its original mission, funding genuine world-changing innovation instead of just chasing the hype of the next big trend?
This is not financial advice.